Listen up. Cape Coral was supposed to be the dream, but right now, Florida's biggest banks are in full-blown panic mode as one of the state's largest real estate markets collapses in real time, and it's sending shockwaves through Miami, Naples, and beyond. Home prices that jumped 75% in 2 years, they're in freefall. Thousands of homeowners are underwater. Insurance companies are fleeing, and the crash isn't slowing down. So how did the American dream turn into a financial nightmare? And who's at risk as the fallout spreads across South Florida? Here's what you're about to discover. First, how an influx of 40,000 out-of-state buyers in 24 months created a speculative bubble that tripled overvaluation warnings. Second, the hidden insurance crisis forcing premiums from $1,800 to over $6,000, and why 6 major carriers have abandoned the state. And third, the regulatory panic happening right now in Broward, Palm Beach, and Miami-Dade counties as lenders and insurers rewrite the rules to protect themselves from the Cape Coral contagion. By the end of this video, you'll understand exactly why Cape Coral's collapse isn't just local news. It's a warning flare for every Sunbelt boomtown. But before we get into the collapse, you need to understand the gold rush that made it possible. Because what happened in Cape Coral didn't start with a crash, it started with a promise. Cape Coral's transformation began with a steady stream of newcomers, but by 2020, the trickle became a flood. Over 40,000 people arrived in Lee County within 2 years, drawn by sun, space, and a fresh start. The city streets filled with accents from New York, New Jersey, and the Midwest. License offices processed a record number of out-of-state swaps. Over 12,000 New Yorkers made the move in 2021 alone, with Illinois and Ohio not far behind. The pandemic had untethered workers from their offices. Cape Coral's palm-lined avenues became a magnet for remote workers seeking more than just a change of scenery. Tech consultants, financial analysts, and digital marketers traded city skylines for canals and mangroves, often buying homes without ever setting foot inside. Some closed in cash, sight unseen, eager to escape high taxes and crowded commutes. And here's where it gets interesting, because it wasn't just families chasing sunshine. There was a second wave of buyers with a very different agenda. Tax policy played its part. Florida's lack of state income tax and lower property taxes offered a compelling alternative for those weary of the Northeast's fiscal bite. Retirees saw opportunity in the state's homestead exemptions, which shielded primary residences from certain tax hikes and creditor claims. For many, the move was as much about protecting wealth as chasing warmth. Second home buyers and snowbirds soon followed, transforming quiet neighborhoods into seasonal enclaves. By 2021, nearly a third of Cape Coral's home sales were to investors or absentee owners. Data from Redfin and CoreLogic revealed that in the busiest months, cash buyers made up as much as 38% of all transactions, far outpacing the national average. But the real danger wasn't the out-of-state plates or the seasonal vacancies. It was what happened when entire blocks shifted ownership in a matter of months. Institutional investors and short-term rental operators, sensing profit, snapped up properties to convert into Airbnbs and vacation rentals. In some neighborhoods, entire blocks shifted from local families to out-of-state LLCs in a matter of months. Local realtors recall bidding wars where buyers from Miami or Chicago routinely offered tens of thousands over asking, determined to secure their place in Florida's boom. Mortgage data showed that more than 33% of 2021 buyers had no previous Florida address, and absentee ownership in certain zip codes doubled in just 2 years. The city's housing market, once rooted in local demand, now leaned heavily on the flow of non-local capital. Here's what most people don't realize. The new arrivals brought energy and money, but also a sense of impermanence. Many viewed Cape Coral as an investment, a hedge against uncertainty elsewhere, or simply a temporary escape. This shifting demographic, remote workers, tax-motivated retirees, and speculative investors, became the backbone of the city's rapid growth. Construction surged to keep pace. Yet beneath the optimism, the city's fortunes grew increasingly tied to buyers who might vanish at the first sign of trouble. And that's exactly what happened. Before we go deeper into the price explosion, I want to make sure you're getting the full picture. If you're finding this breakdown valuable and you want to stay ahead of real estate market shifts like this, hit that subscribe button and turn on notifications. I break down investigative stories like this every week. Stories the mainstream media won't touch until it's too late. All right, let's talk numbers. Cape Coral's home values didn't just rise, they launched into uncharted territory. From May 2020 to mid-2022, the city's median sale price leapt from $239,000 to nearly $441,000. That's a 75% surge in just 2 years, outpacing every major metro in Florida and leaving longtime residents stunned. By the summer of 2022, the typical home was selling for 70% above its long-term trend, according to CoreLogic and Parcel Labs. Now, here's the context that makes this truly insane. A market is considered overheated if it runs even 20% above fundamental value. In Cape Coral, the gap tripled that warning line. For context, a $240,000 house in 2019 was average. By 2022, that same property could fetch nearly double, even if nothing had changed except the sign in the yard. Out-of-state money poured in, pushing up offers and sidelining local families. Remote workers and investors chasing pandemic profits bid up listings with little regard for historical pricing. Redfin's analytics flagged Cape Coral as one of the nation's most overvalued cities, with price-to-income and price-to-rent ratios at record highs. But here's where the story gets darker, because the bubble wasn't just about prices. It was about leverage. Leverage played a key role. Many buyers put down just 3% or 5%. Counting on endless appreciation to cover any risk. Adjustable rate mortgages and interest-only loans reappeared, echoing patterns last seen before the 2008 crash. Mortgage data from Freddie Mac and ICE shows that nearly half of 2021-2022 buyers in Cape Coral borrowed at or above 90% loan-to-value. As prices soared, so did the average mortgage size, stretching household budgets thin and making the market increasingly fragile. By mid-2022, warning signs multiplied. National analysts at Fitch and Moody's flagged Cape Coral's price growth as unsustainable, citing a 70% overvaluation compared to local economic fundamentals. Local agents reported buyers waiving inspections, offering above list price, and closing in cash, behavior more typical of a speculative frenzy than a stable market. Even seasoned investors acknowledged the risks. One told a local paper, "We all knew it couldn't last, but nobody wanted to miss out." This was the benchmark, a city where home prices had run 75% higher in 2 years, with values standing 70% above their long-term trend. The gap between price and reality grew wider by the month. For those who bought in at the top, the margin for error vanished. These numbers would soon become the measuring stick for the downturn that followed, and for the pain that spread across South Florida's housing market. If you're watching this and thinking, "How did I not hear about this sooner?" You're not alone. This is exactly why I make these videos. The mainstream narrative lags behind the data by months, sometimes years. So if this investigation is opening your eyes, do me a favor. Share this video with someone who needs to see it, especially if they're thinking about buying property in Florida. All right, let's get into the collapse. Cape Coral's housing market, once the hottest in Florida, now stands as a cautionary tale. The median home price has dropped to $361,150 as of May 2025, a 7.7% slide in just 12 months, and down 11% from the peak. That's the sharpest decline among major U.S. metros. And it's not just a correction. It's a reversal that few saw coming at this speed. But the price drop is only the beginning. What's happening behind the scenes is far worse. Inventory is flooding the market. More than 3,000 active listings crowd the MLS, quadruple the number seen during the 2021 boom. In practical terms, buyers now face a 7 to 8 month supply of homes, up from less than 2 months during the frenzy. And some local agents report the true figure could be even higher when counting builder-held properties not yet on public lists. For every new sale, 2 new listings seem to appear. Price cuts are everywhere. Nearly 70% of homes now close below asking price, and sellers who once fielded bidding wars are watching their properties linger, sometimes for months. And if you think that's bad, wait until you hear what's happening to the people who bought at the top. Roughly 1 in 7 recent buyers in Cape Coral now owes more than their home is worth. A retired couple from New Jersey who moved south in 2021 with hopes of a sunny, affordable retirement watched their $500,000 home appraise at just $390,000 this spring. Their insurance premiums have doubled since Hurricane Ian, and monthly costs are now hundreds more than their fixed income allows. They've started talking about returning north, but selling would mean bringing tens of thousands to the closing table. Money they simply don't have. First-time buyers who stretched to purchase during the frenzy are feeling the trap even more acutely. One young FHA buyer who closed in early 2022 with 3.5% down now faces a mortgage balance that exceeds the home's current value by over $30,000. Every month, the payment feels heavier. Listing the property isn't an option. They'd need to write a check just to walk away. Instead, they wait and hope, watching prices slide and wondering if their only choice is to stick it out or risk default. Investors who bet on short-term rentals are also underwater. A family from Illinois, lured by the promise of Airbnb riches, put down 10% on a new build in late 2021. Their rental income vanished as tourism softened and competition exploded. Insurance and HOA fees have soared, turning what was supposed to be a cash flow machine into a monthly drain. Their property sits vacant, and they're now exploring legal options to surrender the home without filing for bankruptcy. Across Cape Coral, these stories are multiplying. Estimates suggest 15–20% of pandemic-era buyers are now deeply underwater, especially those who bought with minimal down payments or in flood-prone neighborhoods. We're about to get into the insurance meltdown, and this is where it gets truly terrifying. But before we do, I need to ask, are you still with me? If this investigation has been eye-opening, drop a comment below and let me know what state you're watching from. I want to know how many of you are seeing similar warning signs in your local markets. Let's keep going. Insurance volatility has become the new reality in Cape Coral. Since Hurricane Ian, 6 major carriers have failed or left the state, forcing tens of thousands of homeowners into the arms of Citizens Property Insurance Corporation, the state's insurer of last resort. In the hardest-hit zip codes, Citizens now covers more than 65% of all policies. That safety net comes at a steep price. Premiums that once averaged $1,600 have soared past $6,000. And in coastal neighborhoods, annual bills of $7,000 are no longer rare. But here's what most people don't understand. This isn't just about hurricanes, it's about reinsurance costs. And that's the real crisis. Homeowners who once budgeted for modest increases now face renewal notices showing 60–180% hikes, compounded year after year. One local policyholder saw a jump from $2,900 to $6,600 in a single cycle. Another, after losing private coverage, had a force-placed policy at $5,500, nearly quadruple their original premium. The knock-on effects land hard. Mortgage servicers are demanding proof of insurance before closing or refinancing. And if a policy lapses, lenders step in with their own coverage, often at double the standard rate. For buyers, the cost of insurance is now as important as the price of the home itself. In some cases, insurance premiums alone eat up 30% or more of the total monthly payment. Flood insurance, once an afterthought, has become a deal breaker. FEMA's new Risk Rating 2.0 pushes average premiums from $800 to over $1,400 in newly mapped high-risk zones. Many homeowners, unable to afford the new rates, are rolling the dice by going uninsured, a gamble that leaves lenders uneasy and buyers wary. Citizens' rapid growth is a symptom of a market under stress. The company's policy count in Lee County has more than doubled since 2022. Often exceeding state coverage caps and leaving higher value homes with few options but surplus lines or no coverage at all. Private insurers, facing reinsurance costs that have jumped 30% in just 2 years, are unwilling to write new business in Cape Coral or demand deductibles so high they're out of reach for average families. Each renewal cycle brings fresh uncertainty, with many homeowners waiting until the last minute, hoping for a better offer that rarely comes. The insurance crisis is more than a budget headache. It's a fixed cost that locks in losses and drives down property values. Appraisers now factor in the true cost of coverage, shrinking what buyers can afford and pushing more homes underwater. For sellers, a high insurance quote can kill a deal overnight. For buyers, the unpredictability of next year's bill is a risk many are no longer willing to take. We're in the home stretch now, and this is where everything comes together. If you've made it this far, you're in the top 1% of viewers who actually care about understanding what's really happening in our economy. So here's what I want you to do. After you finish this video, I've got another deep dive on the broader Sun Belt housing crisis. YouTube thinks you should watch it next. And for once, the algorithm is right. Click that video when this one ends. Let's bring it home. In March 2024, Cape Coral City Hall halted all new building permits, citing urgent concerns about drainage and flood risk after a series of high-profile street flooding events. The freeze lasted nearly 2 months, stalling hundreds of construction projects. The city's building department responded by rolling out a new set of inspection mandates and stricter code enforcement. Any home with more than $25,000 in storm damage now requires a third-party engineering certification before permits are issued. Older homes in flood-prone neighborhoods face mandatory municipal electrical inspections. Roof integrity reports are now required for renovation permits, particularly for properties with recent insurance claims. But Cape Coral's panic isn't staying local, it's spreading. Broward and Palm Beach counties are tightening the rules with new floodplain ordinances that go beyond federal maps. In early 2025, both counties adopted stricter building codes for homes in high-risk flood zones, requiring 2-foot elevation buffers and mandatory flood insurance disclosures at closing. More than 18,000 parcels in Broward alone now face these enhanced requirements, reshaping where and how new homes can be built. Lenders aren't waiting for the next crisis. Throughout South Florida, regional banks and national mortgage giants have quietly raised down payment minimums by 5 to 10% for properties flagged as flood-prone or carrying elevated insurance costs. A buyer who once needed 5% down in Fort Lauderdale or West Palm Beach now faces a 10 or even 15% threshold, especially if the home sits within a revised FEMA flood zone. These changes, rolled out in late 2024, are a direct response to the wave of negative equity and default seen in Cape Coral. The insurance sector is bracing for more turbulence. Reinsurers who provide the financial backbone for primary carriers have quoted 30 to 35% higher premiums for 2026 contracts across the state, citing the Cape Coral collapse as a warning sign. This cost surge is already filtering down to homeowners, with new policy quotes in Broward and Palm Beach reflecting the added risk. As these policies spread, the price of buying and owning a home in South Florida rises, and the pool of eligible buyers shrinks. Cape Coral now stands as the warning flare for every Sunbelt boomtown chasing growth without a safety net. Its collapse didn't just reset prices or slow sales, it triggered a full-scale rethink of risk across South Florida. For the first time since the last financial crisis, a post-boom Florida county has seen both home values and market liquidity unravel so quickly that lenders, insurers, and regulators are rewriting their playbooks in real time. The chain reaction is clear. As Cape Coral's prices tumbled, neighboring counties raced to tighten floodplain rules. Lenders doubled down on down payment requirements. Insurers pushed through the steepest reinsurance hikes in decades. Each policy shift, from new elevation mandates to Palm Beach's closing disclosures, traces back to the same flashpoint, a city where the dream of Sunbelt prosperity collided with the hard limits of climate, capital, and confidence. In May 2025, Cape Coral's median home price stood at $361,250, a 7.7% drop from the previous year and nearly $80,000 below its 2022 peak. The evidence leaves no doubt. Cape Coral's collapse has triggered stricter policies and lender requirements across South Florida, and the ripple effects are just beginning. If you made it to the end, thank you. You now know more about this crisis than 99% of people in the real estate industry. Share this with someone who needs to see it, and I'll see you in the next investigation.